Let me ask you something most financial advisors never bring up at the dinner table. You spent 40 years building your wealth, your home, your retirement accounts, your investments. You sacrificed, you saved, you made smart choices. And now you're thinking about the people who matter most, your children, your grandchildren. But here's a question most people never ask until it's too late. How much of that wealth will actually reach them? Because without a plan, the IRS can legally take 40 cents of every dollar above a certain threshold. And that's just the federal government. 12 states and Washington, D.C. have their own estate taxes on top of that, with much lower limits. Today, I'm going to walk you through exactly how to transfer your wealth to your family efficiently, legally, and with as little going to Uncle Sam as possible. We'll cover 5 strategies that work together like a system. Annual gifting, a simple habit that can move hundreds of thousands of dollars tax-free. Irrevocable trusts, the most powerful tool most people never use. Portability, a crucial IRS election that married couples can't afford to miss. Charitable giving, how generosity can be a tax strategy too. The step-up in basis rule, one of the most valuable breaks in the tax code. Stay with me. By the end of this video, you'll have a clear, actionable roadmap. Let's get into it. Before we get into the strategies, I want you to understand something extraordinary about the moment we're living in right now. We are in the middle of the largest transfer of private wealth in American history. It has a name, the Great Wealth Transfer. According to Cerulli Associates, one of the most respected research firms in financial services, a total of $124 trillion in assets will change hands between now and 2048. That's not a typo. $124 trillion. Of that, $105 trillion will go directly to heirs, to children and grandchildren like yours. Baby boomers are the wealthiest generation to ever live. Right now, your generation holds 51.8% of the total wealth in this country, roughly $78.5 trillion. You earned it. You built it. And now, the biggest question of this chapter of your life is, how do you pass it on? Here's the hard truth. A significant portion of that wealth transfer is going to be eaten by taxes, probate costs, and poor planning. Not because the law is unfair. Actually, the law right now is more favorable than it's been in decades, but because most families simply don't have a plan. That changes today. Let me give you the lay of the land, as simply as I can. The federal estate tax. Here's the good news first. Thanks to the One Big Beautiful Bill Act, signed into law on July 4, 2025, the federal estate tax exemption has just reached its highest level ever. In 2026, each individual can pass on up to $15 million free of federal estate tax. For a married couple, that's $30 million combined, shielded completely from the federal government. This is a permanent change, indexed for inflation going forward. That's a massive improvement over where we were just a year ago. But, and this is important, anything above those thresholds gets taxed at 40%. So if your estate is worth $17 million, that extra $2 million faces a $800,000 tax bill. That's real money. Now, the federal estate tax technically only affects about 0.07% of Americans, fewer than 1 in 1,000. But here's what that statistic misses. It doesn't account for state taxes, probate costs, pool beneficiary designations, or retirement account taxes. Those affect millions of families. The annual gift tax exclusion. This is the most underused strategy in America. Every single year, you can give $19,000 to any person, each of your children, each of your grandchildren, each of your nieces and nephews, completely free of gift tax. No forms required. No lifetime exemption reduced. If you're married, you and your spouse can give $38,000 per person per year. That adds up fast. Example, you have 3 adult children and 4 grandchildren, 7 people. You and your spouse can transfer $266,000 per year, completely tax-free, just by writing checks. Over a decade, that's $2.66 million out of your estate with zero tax cost. State estate taxes, the silent threat. Here's what catches a lot of people off guard. 12 states and the District of Columbia have their own estate, or inheritance taxes, completely separate from the federal rules, often with much lower thresholds. For example, New York's estate tax exemption is just $7.35 million in 2026. And New York has a unique rule called the cliff. If your estate is even $1 over 105% of the exemption, the tax applies to your entire estate, not just the excess. So if you live in Oregon, Massachusetts, Illinois, Maryland, or several other states, the federal exemption increase doesn't fully protect you. You need to know your state's rules. All right, let's get into the meat of this. 5 strategies. Each one is a different tool. Together, they form a complete system. Strategy 1. Systematic annual gifting. This is the simplest strategy, and the one you can start tomorrow without hiring a single professional. Every year, give $19,000 per recipient, $38,000 if you're married. Make it automatic, make it consistent. This isn't just a nice gesture, it's a tax strategy. Every dollar you give away reduces the size of your taxable estate. Another powerful move. Fund 529 college savings plans for your grandchildren. Under a rule called superfunding, you can front-load 5 years of contributions at once, up to $95,000 per grandchild, and elect to treat it as spread over 5 years for gift tax purposes. That's $190,000 out of your estate for a couple, per grandchild, in a single transaction. The beauty of annual gifting is that it requires no lawyers, no complex structures. Just intention and consistency. Strategy 2. Irrevocable trusts. Now we step up in sophistication. If annual gifting is a shovel, an irrevocable trust is a bulldozer. When you transfer assets into an irrevocable trust, those assets are legally no longer part of your estate. They are protected from estate taxes. They may also be protected from creditors and lawsuits. And they pass to your heirs without going through probate, saving time, money, and privacy. There are several types worth knowing. SLAT, Spousal Lifetime Access Trust. You give assets to a trust for your spouse's benefit. Your spouse can access the money if needed, but the assets are outside both of your taxable estates. This is one of the most popular tools for married couples right now. GRAT, Grantor Retained Annuity Trust. Excellent for transferring assets that are expected to appreciate. Think stock in a family business or concentrated equity positions. You receive a stream of payments for a set term, and anything the assets grow beyond a minimum rate passes to your heirs tax-free. Dynasty Trust, designed to pass wealth to grandchildren and great-grandchildren while minimizing generation-skipping transfer taxes. If your goal is multi-generational wealth, this is worth exploring. Strategy 3. The portability election. Don't leave millions on the table. This one is specifically for married couples, and it is critically important. When one spouse dies, any unused portion of their $15 million estate tax exemption doesn't have to disappear. It can be transferred to the surviving spouse, effectively doubling the surviving spouse's exemption. This is called portability. But here's the catch. You must file IRS Form 706, the estate tax return, within 9 months of the death, even if no estate tax is owed. If you miss this deadline, the unused exemption is gone forever. Think about what that means. If your husband passes away in 2026 and only used $3 million of his $15 million exemption, you can claim the remaining $12 million. Combined with your own $15 million, you'd have a $27 million shield. Without the Form 706 filing, you'd only have $15 million. That's a potential $12 million difference. At a 40% tax rate, that's nearly $5 million in avoidable taxes. This is not a technicality. This is one of the most important actions a surviving spouse can take. Strategy 4. Strategic charitable giving. Giving to charity isn't just generous. When done strategically, it's one of the most tax-efficient moves available to people over 60. Let me give you 3 tools specifically designed for your situation. Qualified Charitable Distribution, QCD. If you're 70.5 or older, you can transfer up to $105,000 per year directly from your IRA to a qualified charity. This distribution is excluded from your taxable income entirely. Even better, it counts toward your required minimum distribution, so you're satisfying your RMD without adding to your taxable income. For someone in the 24% or higher tax bracket, this can save thousands of dollars a year. Donor Advised Fund, DAF. Think of this as a charitable savings account. You make a large contribution, getting an immediate tax deduction, and then recommend grants to specific charities over time, at your own pace. Your assets grow tax-free inside the fund. This is especially powerful in a high-income year, like the year you sell a business or a large piece of property. Charitable Remainder Trust, CRT. You donate appreciated assets to a trust, receive an income stream for life, avoid capital gains tax on the sale of those assets, and the remainder goes to charity. Complex, but powerful for the right situation. And here's a new benefit for 2026. Even if you take the standard deduction and don't itemize, you can now deduct up to $1,000 in direct charitable contributions, $2,000 if you're married filing jointly. That's a small but real incentive for everyone. Strategy 5. The step-up in basis rule, possibly the most valuable break in the tax code. This strategy requires no action, no attorney, and no trust. It's built into the law. But you have to know about it to use it correctly. Here's how it works. When you die and leave assets to your heirs, stocks, real estate, a family business, those assets receive what's called a step-up in basis. That means your heirs inherit them at their current fair market value on the date of your death, not at the price you originally paid. Why does that matter? Because when they sell, they only pay capital gains tax on growth after they inherited the asset, not on decades of growth that happened during your lifetime. Imagine you bought Apple stock 30 years ago for $5,000. Today it's worth $500,000. If you sell it yourself, you pay capital gains tax on $495,000 in gains. But if you hold it and leave it to your children, their basis is reset to $500,000. They sell it for $500,000 the following year, zero capital gains tax. The step-up in basis can wipe out decades of capital gains completely. Here's the trap most people fall into. They gift appreciated assets to their children while still alive, thinking they are being generous. But gifts carry your original cost basis. Your children inherit your tax problem. Instead, gift cash or low appreciation assets during your lifetime. Keep the highly appreciated assets, real estate, old stock positions, and let them pass through your estate to get the step up. Let me make this concrete with 2 families. Example 1, the middle-class family. Robert is 67, recently retired from a career in manufacturing. He owns a home worth $900,000, has $1.2 million in his IRA, and $300,000 in a brokerage account. Total estate, $2.4 million. Under current federal law, Robert's estate is well below the $15 million threshold. No federal estate tax. But Robert lives in Oregon, where the state estate tax kicks in above $1 million. His estate is $1.4 million above Oregon's exemption. Without a plan, his children could owe a significant Oregon estate tax bill. By simply implementing annual gifting and reviewing his beneficiary designations, Robert can reduce his taxable estate substantially over time and make sure every dollar of his IRA goes to his children, not the state. Example 2. The affluent couple. Margaret and Tom are 71 and 68. Their combined estate, including their home, investments, and Tom's small business, totals $32 million. The federal exemption for a married couple is $30 million in 2026. That leaves $2 million exposed to the 40% estate tax, an $800,000 potential tax bill. But with a spousal lifetime access trust, a systematic gifting program giving $38,000 per year to each of their 6 grandchildren, and a grant-to-retained annuity trust to transfer Tom's business interests, they could eliminate that $800,000 bill entirely and potentially transfer millions more tax-free over the next decade. The strategy works, but it requires starting now, not waiting until a health crisis forces the conversation. Before I give you your action steps, let me warn you about the 5 most common and costly mistakes I see families make. Mistake 1. Outdated beneficiary designations. Your IRA and 401k pass to whoever is named on the beneficiary form, not according to your will. If you named your ex-spouse 20 years ago and never updated it, that's where the money goes. Review every account today. Mistake 2. Adding children to property titles. Parents often add a child's name to a home deed thinking it simplifies inheritance. It often backfires, creating capital gains tax issues, potential exposure to the child's creditors, and complications if the child goes through a divorce. Mistake 3. Missing the portability election. As I mentioned, surviving spouses must file Form 706 within 9 months to claim the deceased spouse's unused exemption. This is not automatic. Missing it is an irreversible and potentially catastrophic mistake. Mistake 4. Waiting until a health crisis. Estate planning is most effective when you're healthy, mentally sharp, and not under time pressure. A plan made under duress, or worse, a plan never made at all, leaves enormous amounts of money on the table. Mistake 5. Setting it and forgetting it. Tax laws change. Your family circumstances change. Your assets change. A good estate plan needs to be reviewed every 3 to 5 years. The plan you wrote in 2018 may be completely outdated today. Here's what I want you to do this week. Not someday. This week. 1. Write down your total estate value. Include your home, retirement accounts, brokerage accounts, life insurance death benefit, and any business interests. You need a number to work with. 2. Review your beneficiary designations on every IRA, 401k, and life insurance policy. Log into each account and confirm the names are correct, current, and reflect your wishes. 3. Schedule a consultation with an estate planning attorney. Many offer a free first meeting. Bring your numbers. Ask specifically about annual gifting, portability, and any state-level estate taxes in your state. That's 3 steps. They take maybe 3 to 5 hours total. And they could protect hundreds of thousands, or millions of dollars for your family. Because here's the thing. You didn't build this wealth for the government. You built it for the people you love. And the greatest gift you can give your children isn't just money. It's a plan that makes sure it actually reaches them. If this video helped you, please hit the like button. It helps more families find this information. And subscribe so you don't miss our next video on how to use a trust to protect your assets from nursing home costs. I'll see you there.